All right. So now, today, the second part of it, what I'm going to teach you is actually the calculation of depreciation. Okay. I know in part one, I've actually explained to you what has actually taken place. I've already shown you this balances brought down. Okay. This is a balance brought down, the cost of it. And this is the balance brought down, which is the provision of it. Okay. So this both, this is a balance BD. Okay. So this is a balance BD as at first 10 2019. Okay, so part 3 I will teach you all how to put into the respective accounts. Okay, so back to this now, calculation of the depreciation. Now this is what we are going to focus now. Very important when you're doing this, it is you need to know what are the information. Okay, information here, if you can see, Sarah's policy is to provide depreciation for fixtures 10% per annum, okay, using the reducing balance method. So this is what you need to focus on. It's a reducing balance method and it is 10% per annum. Another very important keyword that you need to see here is actually, when do you actually provide for depreciation? Okay, so in the year of purchase, okay, none in the year of disposal. So this is one, and full year's depreciation in the year of purchase. So this is the keyword that you need to know. So I'm marking here disposal year, no depreciation. That means even if you sell it, like say you use for the whole year and you're selling it on the 12th month, the beginning of the 12th month, there's no depreciation for it. Okay, but whereas if it's purchased, say you purchased it purchase here, okay, purchase here, there is depreciation. Okay, there is depreciation. And same, even if you didn't have the asset for the whole year and you only got it say on the 12th month and the beginning of the 12th month, you still need to create the depreciation for the whole year, full year. Okay, so this is Saria's company's policy. Okay, now very important, you need to know, you see this asset was purchased when, okay, so this asset was purchased, is very important, on 1st February 2018. Okay, that means the asset that has been sold was purchased on 2018. Okay, this is your financial year. Okay, this is your financial year. Now green, so this is your financial year. So if you look at it, it is very clear that this asset was purchased not in this financial year. So this is why I say it's very important. Every question you need to know your financial year, because for IG, if you see, most of the time they won't give you January to December. They can give you from March to starting in March, starting in April. They can start anywhere within the year, but you must know 1 year is 12 months. So you need to know how to calculate. So let's go. So 1st February. So let's see the year end now. Okay, so this is 1/10/2019 to 30th September 2020. So if you look at this clear cut, this is not the year they purchased. Okay, now go backward. So backward means 1/10/2018 to 30th 9/2019. Okay, look at this range of here. Do you think 1st February 2018 falls in this range? Obviously, if you see, February 2018 is not in this range. So we go another year backward, which is 1/10/2017 up to 30th September 2018. Okay, so this is the year that you purchase the asset. Can you see? February 2018 is in this range. So whatever it is, you don't have to worry, because it's a full year's depreciation that you're going to charge in the year of purchase. So how many years you actually acquired or you had this asset with you? This is year 1, this is year 2, and this is year 3. So now making it clear, based on this information here, okay, based on this information here, in the year you dispose it off, you don't have to depreciate. So in this year, there's no depreciation. Obviously, this year you have, this year you have. And it's a reducing balance method of 10%. So now I'm going to calculate the depreciation for the disposed asset. Okay, so I'm going to show you here. So for year 1, now year 1 is very simple. The cost of your furniture was 1,005. You just times 10%. So you get 150. So this is your depreciation for year 1. Now year 2. Okay, year 2 depreciation. Remember, it's a reducing balance method. So you take your cost, which is 1,005. You minus with your 150. Then you times with 10%. You will get 135. So these two added up, you get your answer, which is 285. So this is the depreciation for the disposed vehicle. So I hope you are clear. So it is very simple, but you need to really think before you do it. Okay, so see carefully, when did they purchase, and you know what's a financial year. So go backward and determine your year, which year, and you have to see how many years you have used up. So as I told you, this is another very key important thing, the disposed year, whether there's depreciation, and whether the year of purchase, whether they have it or no. You need to know the company's policy. So in one word, you need to understand what is written here. Okay, so you're done for number one. Okay, number two, very simple. For number two, you have 2860. Okay, number two here, the asset, the remaining asset. Okay, for the remaining asset, okay, 2860. Now, please bear in mind that 28600, okay, 28600, you have to minus the asset that you have disposed. So your new cost is actually 28600 minus 1005, you get 27100. Okay, so this is your new, sorry, this is your new cost that is still remaining with you. Okay, now same goes to your provision. How do you calculate your provision? You had 6185. So 6185, you have to minus the provision for depreciation for this 1500, which is easy because you just calculated it. You just calculated it. So this is the provision for the asset, which is 1005. That means over the 2 years, or sorry, over the 3 years, you had the asset of, obviously the third year you didn't do depreciation. But for the first 2 years, the accumulated was 285. How you know? I just did the calculation and I explained to you. So 6185 is inclusive of this 285. So what you're supposed to do here is you minus your 285. That's it. So you get your figure, that is 6185 minus 285, you get 5900. Okay, so this is how you get the provision balance. Okay, so these are the new balances after minusing, after minusing the disposed asset. Okay, so I'm making it very clear. Okay, so the last part here is I'm going to calculate for the new asset, and part 3 of the video will show you the entries. Okay, so new asset is very clear. The new asset that you bought was 3500. So 3500 is the cost, and this is the first year. Purchase year, there is depreciation. There's a full year's depreciation, and obviously you purchased it on March 31st. March 31st is in the range of this year. Therefore, year one, only year one, which is this year, what you do is 3500, you times with 10%. So you get 350. Okay, since it's the first year, there's no accumulated depreciation. Therefore, you get 350. Now, what is the new depreciation? That means the depreciation that you charge to income statement. So income statement, you must understand, there will be two. Okay, in the income statement, the depreciation that you're going to charge, obviously one is the disposed part. Okay, disposed part you'll minus off, which is 285, and the other one is the remaining and the new. So the remaining and the new, you just add up. Remaining and new, if you add up, you will get oh, this is 350. This is the new one. Sorry, the remaining one I didn't do. Okay, so I'll do it right now. How do you get the remaining one? It's very easy. You know your new cost is 27100. Okay, 27100, you minus your 5900. Okay, then you times your 10%. That's it. So this will be your remaining assets depreciation. Okay, 27100 minus 5900. Okay, you get 2120. Sorry that I forgot to do the calculation for the depreciation. Okay, so this is year one. This is this is the disposed asset. This is the remaining asset, and this is the new asset. So the remaining and the new, when you add up, you will get, this is the one that goes to your income statement. Under the income statement, depreciation for the year will be 2470. So I made it very clear. And as I told you, no matter which method of depreciation you're using, whether it's reducing balance method or the SLM method or the revaluation method, the entry is always one, which is you debit your income statement and you credit your provision for depreciation. Okay, so this is the fixed entry for you. So I hope you all are clear. Part 3, I will show you the entry.